Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We've just released our monthly India market outlook titled Attractive Income Opportunity. In today's podcast, we summarize our key asset class views. Before we get to that, a quick roundup of the past month. Indian equities have begun trailing their global peers in 2023, given elevated valuations, foreign investor outflows from equities and a sharp sell-off in a large domestic conglomerate. Over the last month, the Nifty index is down 0.3%, tailing the MSCI World Index, which is up 4.2%, and MSCI Asia ex-Japan, which is up 0.6%. The INR is down 1% against the USD after a strong recovery since mid-January, while the benchmark 10-year Indian government bond yield is up 6 basis points to 7.36%. In our assessment, bonds offer an attractive income opportunity with interest rates likely to peak in the near term. The government's sticking to the fiscal consolidation path amid improving quality of fiscal spending is supportive of bonds. Overall, we maintain a balanced asset class outlook given elevated Indian equities valuations, both absolute and relative to peers, indicating a lower margin of safety. As we had highlighted in our annual outlook for 2023, the SAFE strategy remains a prudent way to navigate 2023. S in the acronym SAFE is for Secure Your Yield, where the focus is on attractive yields available currently, especially at the shorter end where the risk-reward trade-off is better than medium to long maturities, and large caps, which offer a greater margin of safety over mid and small cap equities in terms of valuation and earnings. A in the acronym is for Allocate to Long-Term Value, where the focus is on structural themes which have a longer runway for growth. We see attractive value in financials, domestic cyclicals, and the investment-led themes like infrastructure and manufacturing. F is for Fortify Against Future Surprises. Not to forget that the 2023 macroeconomic backdrop remains challenging, and that's why we feel allocation to cash, gold, and a defensive tilt among equity position through consumer staples is a prudent approach to ride out any unexpected jump in volatility. And finally, E is for Expand Beyond the Traditional. A key learning from 2022 was the stock and bond correlations, though generally quite low, can rise unexpectedly in some years, and that's why we feel that allocation to uncorrelated assets through alternate investment strategies are a prudent allocation. Now, moving on to individual asset classes, we have a neutral stance on Indian equities. Stretch valuation premiums, both absolute and relative to peers, is counterbalanced by robust growth and resilient earnings expectations. Within equities, we are overweight large cap equities given relatively better macro fundamentals and a greater margin of safety in terms of earnings and valuations compared to mid and small cap equities, which we have downgraded to underweight. Coming to bonds, we maintain a neutral stance as attractive absolute real yields are counterbalanced by lower yield premiums, stretched medium-term fiscal condition, and weak government bond demand-supply balance. Rising interest rates remains a headwind for bonds. Within bonds, we are overweight short maturity bonds given their lower sensitivity to rising interest rates. Cash remains a neutral weight, and finally gold remains a neutral weight and a key portfolio hedge against elevated inflation and equity market volatility.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.